Yeah.
So, as the title says, how to live pre-tax using Dynasty Trust. That's really the essential living benefit from a logistical standpoint. As you're live now, as you're doing what you're doing, why this makes a lot of sense. So, we'll talk about that again. As with all of our presentations, none of this is tax, financial, or legal advice. We do give financial, tax, legal advice when you hire us. So this is just for educational and informational purposes. Don't assume anything here applies to your specific situation. I'm going to make sure Michelle gets this out to you. We're at the tail end of our masterclass being completed. So once that's done, a lot of this stuff, the questions that you have when you come to Trust Tuesdays, it will be answered in the masterclass because that's more in depth. We have a PDF guide as well, some FAQs that go over some stuff. So you can email Amanda to get a copy of that as soon as it comes out. But as usual, we'll also send an email blast to everyone as well because we have a good amount of people that have requested it. And everyone here that's on the call has already subscribed to Trust Tuesdays. But if you haven't, if you know any friends, family members, colleagues, clients, make sure they go to the link to subscribe to Trust Tuesdays, and Michelle will drop that in the chat. For those of you guys that don't know who we are, again, we're Prudent Wealth Strategies. I'm Stefan Bellholmes, my wife, partner in crime, and business partner, Michelle Nice. We are both tax strategists. We're out of Pinehurst, North Carolina, which is about an hour south of the Raleigh-Durham area. And we essentially help business owners, investors, and even tax firms around the country with advanced tax structures like the Dynasty Trust. It's one of our flagship products, flagship solutions for a lot of people because it's just very versatile. And we help people all around the country. We have a whole team behind us, and that's important that we stress team because a lot of people, when they may have a good, CPA or accountant or maybe an attorney, but they're not focused on a lot of these advanced structures and they don't have the bandwidth to help their clients with these types of things. So that's what our team does. Forensic CPAs, tax attorneys, bookkeepers, strategists, this is all they do, setting up these structures and making sure they're set up right and that you comply with these things on an annual basis. Because it's one thing to get it set up. It's another thing to make sure that it's operated properly on a consistent basis. So these are just some of the specialized tax structures we work with: trust, private foundations, charitable strategies, risk management companies, different types of trust. Again, the Dynasty Trust is kind of our flagship trust structure that we work with. So we want to go into trust rules. This is kind of the paramount foundation rules of why this makes sense, how it works, and how you want to navigate things. Number one, never pay more taxes than what you live on, right? At the end of the day, you work, you earn money, you pay taxes, and then you have bills and expenses and things that you have to pay for. We'll go into the red bucket, blue bucket thing. But as an investor or business owner, you have the ability to control some of that income, right? If you're a W-2 person, you just work a salary position at a job, you don't have control. You're getting paid, whatever your salary is, that's what you're going to use to live on or invest, whatever. Yes, you can, fund your 401k and things like that pre-tax, but for most of the situation, whatever you make, you're going to make. Business owners, investors, whole different can of worms. You can control some of that. So never pay more taxes than what you actually live on. And we're going to detail and go in depth today about what those actually living expenses are, because a lot of the expenses that most people have out of their pocket that are personal expenses can be trust expenses. And it's going to save you a tremendous amount of money. Own nothing but control everything. That's super important because whatever you own in your personal estate, you have to deal with taxes, liabilities, and lawsuits. So this is all about doing things on a pre-tax basis. And if you own things in your personal name, you don't get that benefit. Using the trust, living in the trust estate, you do. And today, really the last 3 bullet points are going to really be important for today because number one, if the trust owns it, the trust, not you, pays the bill. I'm going to say it again. Number one, the trust owns it, the trust pays the bill. So we have to understand that this is a different way of doing things from the standpoint of, hey, I like to have my things in my name, my cars, my properties, whatever in my name. Okay, great. Guess what? You have to pay those bills because it's owned by you. We want to shift it to the trust owning those things because now the trust can pay it, and the trust can pay it with pre-tax money versus after-tax money, right? And that's a huge deal when you start earning a lot of income in your business or your investments or whatever you're doing. And then last but not least, the trust can pay for many lifestyle expenses with pre-tax money. We'll go into detail what those are: health, medical, welfare, education, things of that nature. So the focal point of understanding the difference between the dynasty trust and the personal estate is, again, your personal estate, you have taxes, liabilities, and lawsuits, right? Everything in your personal name, you have to work, earn money, pay taxes, and then be able to put that in your personal estate. But you also have to deal with liabilities and lawsuits. Anything in your name can be taken away from you from a lawsuit. Even if you have insurance, they could sue you for human life value, all these different things. So having things in your personal estate where you have ownership of it is not a position of control. Okay. If you want control, you really have to give up the ownership. That's what the whole own nothing, control everything really means. It's not saying that you don't want to have control. You do want to have control. It's just where are you controlling things from? And so
And I just want to, I'm sorry, go ahead, Stefan. When
yeah.
you finish with
And so
this.
yeah, the trust estate is what gives you the ability to have true control over your assets.
Sorry, I just
Go
wanted
ahead.
to accentuate that little point right there, because it's not so little, it's huge. And it's a big paradigm shift for a lot of people, because everything we have been taught is to really benefit the government. Think about it, grow up, go to college, get a college loan, pay interest on that loan to the government, get a job, buy a house, get a mortgage, pay more interest. You know, get a 401k, let them determine when they're going to tax us. Yeah, we get to defer it for a while. They're going to make sure we have RMDs, required minimum distributions. It's like the government has really manipulated us. Okay. They manipulated us into pride of ownership. Own everything, put everything in your name. Great. There's a big target on your back if it's in your name. If you have an LLC and you're a single member, disregard it. You're the owner of that membership. If you have a partnership, like, it's just a flow through. It's still attached to you. So I just want to, there is a big paradigm shift when it comes to the dynasty class of trust, because it goes against the grain of everything we've been taught and what the government wants us to know, although it's right there in the Internal Revenue Code, all of this.
100%. And I'll just kind of echo the at the end of the day, it's a choice. Everybody has a choice, right? You can do things. Most people, 99% of people are going to do things right here. That's just how it is. The people that understand this concept, again, these trusts, these strategies aren't new. These things have been around for a very, very long time, but it's ingrained in their mentality, and they train their kids, and it's like second nature to them. So yeah, it's definitely a paradigm shift, but it's also an educational shift in how you do things, how you do your investing. Because again, the trust can do the same thing. It's an entity, right? And what people don't understand is trust, for legal purposes, have the same constitutional rights as an individual, right? You have the right, it has the right to privacy, has the right to not self-incriminate itself. It is an actual entity, but it passes things through differently. Um, so yeah, so the what most people do, again, you work, you earn money, you pay taxes, and then you have all your expenses, your investments, your bills in there, and you're paying for your expenses with after-tax dollars, right? Whereas with the trust, we want to flip that on its head: work, earn money, avoid the tax or minimize the tax, give you really tax control, right? That's the part of the control, is it asset control, privacy control, and tax control, right, with the dynasty trust estate. And now you can pay for those same expenses, but with pre-tax dollars. So what is a trust expense? Trust expenses, and some of you, if you've ever heard the term trust fund baby, right? We've heard that term a lot. It's usually associated with rich people, people that have a lot of money. But every trust, these types of trusts have what's called a trust fund, a trust corpus, okay? Bank account, all that stuff. So those trust expenses are paid for with money in the trust fund, but the money in the trust fund can only be used for two things: for trust expenses or investments, right? So if the trust wants to buy real estate, the trust can buy real estate. You're not buying the real estate. The trust wants to buy a car. The trust can buy a car. You're not buying the car. And trust responsibilities. So trust expenses, trust responsibilities. That's what the money inside the trust can be used for. So one of the biggest ones is your primary residence. Okay. So when we talk about your primary residence, we're talking about your mortgage payments, talking about property taxes, homeowners insurance, utilities, right? Everything is going up now with costs, right? With inflation, electric, water, gas, internet, everything, all these things are going up. These are actual trust expenses, and we'll talk about how that works. But when you have your primary residence inside the trust, we can use the trust dollars to pay for all of these things: security, improvements, you need a new roof, appliances, furniture. Now, appliances and furniture are what we call trust chattels. It's not actual trust property, trust chattels, which are basically any object other than real estate. So they're still part of trust property, but it's not real property. Real property is obviously real estate, things of that nature. But those are all things that are owned by the trust. So we can use dollars in the trust to go pay for a new fridge or a washing machine or dishwasher or whatever it is. And appliances aren't cheap nowadays, right? Are they? We just got, what did we get in
No,
the
they're
past
not. Oh my
year?
gosh. We got a refrigerator, a dishwasher, the upstairs AC unit went out. Apparently a lot of people's did, so we're on the wait list for getting one of those replaced. I don't know. I feel like we bought something else.
Dishwasher,
Yeah, dishwasher,
dishwasher.
refrigerator, and the AC unit.
And oh yeah, and the stove and during COVID we
Oh,
got
and the
the
microwave.
stove and the
Yeah, stove
microwave.
and the microwave. And this house
Um,
is only 10 years old.
yeah.
So apparently they only make appliances to last about 7 years or so. That's the average lifespan now of appliances
It's
because
ridiculous.
yeah. But this is a really good point that Stefan's making right here. When you just operate on a pre-tax basis, it depends on your tax bracket. But if you're saving like 25 to 35% on every single bill. We have the gutter guy come out, the bug guy, when we lived in South Florida, we had the pool guy. We don't have a pool up here right now. We go to the club for the pool, but the pool guy, anything that is in regard to the house. Oh, we had the garage door fixed.
Oh yes, that
Had the
too.
garage door fixed. Yeah. Anyway,
I mean,
there you go. Much more efficient way of doing things inside the trust.
yeah. Any questions? Pretty gun dry? Okay. Now, with mortgages, one of the questions we get a lot is, okay, how does it work with the mortgage? Specifically when it comes to the due on sale clause. Is anyone here not familiar with due on sale?
I don't know what that means. Can you explain that?
Yep. So the due on sale clause or an innate alienation clause is essentially when you're selling a property to someone, right? You have your house or it's an investment property. If I sell it to someone and I have a mortgage on it, that mortgage needs to be paid off, right? And so what typically happens is if it's an actual sale, well, I'm selling it to another party, to another buyer, that person's gonna, give me cash, or maybe they're getting a mortgage, whatever, and everything is gonna transition through, before closing and at the closing table with the title company, where the loan is going to get paid off because it's a new person assuming the property. And that's that. So that's essentially what a due on sale clause is. So when we're working with the Dynasty Trust, remember, we're selling the asset over to the trust. We're not gifting it over to the trust. So therefore, because it's a sale, one would think that there's a due on sale clause. There's a new owner, quote unquote, of that property. So the mortgage company is going to trigger that clause. Okay. And so that's one of the things that people constantly bring up when it comes to the trust is, oh, if I sell my property over to the trust, it's great. The trust can pay for all the expenses, but what about the due on sale clause? So with these specific types of trusts, there's no due on sale clause, number one, because remember, again, the property is sold over to the trust through a notarized bill of sale. So it's an actual sale. We're selling the property over. Again, we're selling it at cost. We don't have to create a game where we're selling our property over to the trust. But what's happening is this is a private transaction. So when we're selling everything to the trust, we're doing it through a notarized bill of sale, through, purchase and sale agreement, through a deed, warranty deed, quitclaim deed. Most of the time it's going to be a quitclaim deed, but it's a private transaction. This is a private trust. It's not a public trust, not a testamentary trust, it's not a living trust. Okay. It's not a statutory trust. So there's no public record of this. So this is a private contract, private sale. So no, the bank is not going to be none the wiser. So I can sell my property to my trust legitimately, use title company, all that stuff, and the bank would be none the wiser, if that makes sense. So they wouldn't know in the first place. Number one. Number two, I have to file the deed. Okay. Because it's a private transaction, I don't have to file the deed. Now, let's say I did want to file the deed. Okay, you can do that. Even yet and still, there is a provision created by Congress. Again, you have to think about who creates these things, who creates these structures and these strategies, right? Called the Garner-St. Germain Act, which provides special protection when a property is sold to a trust, specifically to these types of dynasty trusts. So just keep in mind, yes, we're selling everything over to a trust, but you are the trustee of the trust. So it's essentially a private sale. So now if you were selling it to someone, another party, yes, obviously you'd want that more, loan to be paid off and all that stuff. But everything's just happening. You're taking something from one pocket and putting it to the other. And most of the time, as long as the mortgage is still getting paid, the bank's not going to care. Banks don't really care who they get the money from, as long as they get the money. So,
I have a question.
Yeah.
So if I'm looking to buy my first home and I'm looking at different grants and different money lenders, and if I was to transfer this over to a trust, are you saying that my name for those grants and lenders would still be under my name and not the trust?
Yep.
So I could still like as soon as I buy my first property and get all that income in, I could just first day out just transfer it over.
Yep.
Okay.
You got it.
That's awesome.
Yep. Good question. So, vehicles. So again, anything the trust owns, the trust pays for. So vehicles, you sell your car over to the trust can pay for the loans, the insurance. In Florida, I know, Christine, you guys don't have to deal with this, but in North Carolina, we have property tax for our vehicles, which sucks. Registration, inspection. These are all costs that you have to absorb when you have any type of vehicle. Charging stations, maintenance, need oil changes, all these different things are expenses that can be paid for within the trust. Now, the way that it works technically, and I'll draw this out a little bit when I throw my iPad, is anything that you're going to be using as a trustee. So what happens with the trust is you're the trustee again, you're the one who has control, right? But because you're driving and you're living in the trust houses or property or whatever, you're technically using a portion of that, which legally you're allowed to because you have what's called beneficial interest. You don't have ownership, but you have beneficial interest in that trust. Okay, and that's something to kind of understand from a legal standpoint. But you're using a part of that trust. So the way to make it work legally is we're required to put together something called a personal use lease. Okay. So when you're living in your house or you're driving the trust car, you're going to pay a lease expense to the trust for the use of that. And there's different ways to calculate it. It doesn't have to be a whole lot. But it's a much more efficient way of doing things. Number one, it helps obviously from a legal standpoint. And number three, that income that you're paying to the trust is not taxed because that's lease expense. It's lease income. Okay. So there's times when you're going to need, again, going back to the whole own nothing, control everything, you're going to need to have some money in your personal estate. We just don't want 100% of your wealth to be inside your personal estate, inside this Fred box. So hopefully that makes sense, but that's how it works from, okay, yes, I'm living here, I'm using the trust, things. How do I know that this is legit? How is this legal? And the legal way that it works is, yeah, you're using this, right? So we have to find a way to justify that. We do that through the personal use lease. It's no different than if you had a company vehicle and they expense it through there and put on your W-2. But that's how it worked from the trust
I
standpoint.
think
Does
the
that make
visual
sense?
will help too. I think the visual, when you draw
Yeah.
that out, will really help solidify that concept. Any questions about that?
Yeah.
Yeah, but I'll wait till you go through it.
Okay.
Yeah.
Okay. Perfect. Um, So trustee expenses. So going back to what I said before, remember the trust is required to pay for trust expenses and trust responsibilities. So one of the responsibilities of the trust is trustee expenses, because remember, this is all about showing you guys how to be the trustee and you guys how to have control. Because you could, if you wanted to, go hire a trust company, right? Go hire a fiduciary to, run things and take care of things. But then you don't have control, right? The control's in their hands. So just like you would hire a trustee company and there's expenses that you would pay for that, you can do the same thing as a trustee, and the trust is required to do that. So one of those things are health insurance, right? Because your job is to maintain the trust, to grow the trust for the beneficiaries. And you can't do that if you're not in tip-top shape. So if you have health insurance expenses, and obviously we're talking about people that are self-employed, business owners, investors, whatever, you're paying full price for your health insurance. So why not have the trust pay for your health insurance? Now, going back to kind of what we talked about before last week and weeks before, when you have a business, when we're talking about personal income, if we can shift income from your business, from your investments that's showing up on your 1040 to the trust return, you're going to show less income on your personal return. What does that mean? Okay, if I want to get Obamacare, instead of paying, $5,000 a month for health insurance, I'm showing a lot lower income. So I can go ahead and get a subsidy and get on Obamacare, get my insurance. And whatever, premium I'm paying, the trust can pay for that. So my bill went from 2,000. We have clients, and we can go over this another time. They're paying $2,500 a month. Now they're paying $100 a month for a better plan with lower deductibles, because now they can qualify for Obamacare.
'Cause they look
But that
more on paper.
expense,
Yeah.
yeah, looking poor on paper. That's what this is all about. So now that health insurance becomes an expense. But even if you have the best health insurance, there's a lot of expenses that are not covered by your insurance, right? Chiropractors, dental, vision, orthodontia. I'm probably going to need to get braces in the next few months. My daughter's going to need braces. Those are trust expenses. Um, Life insurance, and education. So you as a trustee, the trust can't pay for education, but if it's only for things that are needed to perform your duties as a trustee. So if you're going to get a college degree, your first degree in psychoanalytics or political science, that's not a trust expense. But if you need to take some continuing education or whatever around finance or whatever, there's a lot of different things. And I don't want to get too into the weeds when it comes to bookkeeping, because that's a back office question as far as chart of accounts and what's actually expensible. But there's lots of different things that we've seen where education can be covered for the trustee.
But just going
Any
back to
questions on that?
the health insurance part, Stefan, I just want to
Mhm.
touch on this. If you have elderly parents who might need long-term care, okay, that's really, really expensive. North Carolina and Florida are filial responsibility states, which means they can do a Medicare spend down on your parents, but then your next of kin adult children, they can also come after your assets. Google it. If you don't know it, it's called filial responsibility. So
Yeah,
you can
it's
name
huge.
your elderly parents as a trustee as well. Okay. You actually are going to hold a couple roles, because you'll be the trust administrator, like the guardian and the trustee. So you have ultimate control, right? You yourself. but then they can get that long-term care paid for out of the corpus of that trust, which is a much more efficient way of doing things. Plus, they can, keep their assets, they can, there's all kind of things to do with that. That's a whole nother conversation, but it
Yeah.
is an
But no,
extremely powerful conversation because that's an extremely big expense, especially
yeah,
with adult parents living longer,
you're talking
something to consider.
easily 3, 4, 5 grand a month,
Oh,
easily with
sometimes
those
10,
expenses.
Stefan, 10. I've even seen 12,
Yeah,
15
if
down in South
if they're doing
Florida
it,
by the beach.
yeah. Yep, we might get the nice places,
Yeah,
which I actually used to work at an assisted living facility in
long
when
time
I lived
ago.
in
Full
Miami,
circle.
long
Full
time ago. But yeah, those are all things that can be paid for with trust dollars on a pre-tax basis. So it's a big deal, especially when you start to go into those very expensive costs for healthcare.
And plus the beneficiary.
Um,
If you have children, here you go. You're going to go over it. All right.
yeah. So beneficiaries, so your kids, or my kids, whoever you want to have as beneficiaries on your trust. The trust can pay for expenses for them if they're under age of 21 or they're special needs or disabled. Okay, the trust can pay for their health insurance, their out-of-pocket healthcare expenses, just like you. But it also can pay for their food and clothing. This is what we call welfare, right? Because you have kids. They're going to benefit from the trust someday. We want to make sure that they're growing up healthy and strong. They can't do that if they don't have a roof over their head, they don't have the proper food and nourishment, they don't have clothes. So a lot of these expenses, again, that you typically would pay for after tax, right? Going to, the mall, Aventura Mall, remember that in Florida, which is super expensive. For, back to school shopping, things like that. We just had to go through that. Those are all expenses that can be paid for with the trust. In addition to education, college expenses are just ridiculously expensive nowadays. And this is one of the things that we do with the trust is showing people how to reduce their income, pay less taxes, number one. Number two, qualify for a lot of financial aid at some of these expensive schools like, North Carolina or at Duke or Harvard or MIT. These schools have millions of dollars of endowments, but they only give it to families that are showing low income, that don't have a lot of money on paper. So the trust obviously allows you to do that legally. And if we have time to do that, it makes all the sense in the world. And on top of that, if there's any other expenses, then we can use the money inside the trust to pay for those expenses. So it's got a really, really, really good benefit when it comes to education on that front. Any questions about that? No? All right. So what can't the trust pay for? And I want to end it with this. We'll get into some drawing. Is at the end of the day, not everything can be paid for by the trust. And there are going to be things that you need to have money for in your red bucket, in your personal estate to pay for. We typically call those food, fun, fashion facelifts. Okay, right? You need groceries when you go to McDonald's, go to Disney World, movies. Hey, Jordans, want a Gucci purse? Not for the kids. Remember, for the kids, the trust can pay for those things. Probably not a Gucci purse, but they need some Jordans or some clothes, whatever. The trust can pay for that. And then obviously anything that's not medically necessary, you want a tummy tuck, whatever. There's a lot of things that the trust can pay for. So there's a chart of accounts with the trust. There's actual bookkeeping that needs to be done. Balance sheet, P&L, all that stuff. So you obviously want to make sure you're doing things the right way. But at the end of the day, we want to make sure that going back to rule number one, right? You don't pay more taxes than what you live on. Look at what those actual expenses are right now. This is an exercise that we take our clients through once they begin onboarding, is we say, hey, let's look at all the different things that you're paying for right now out of pocket. Okay, not things that you're writing off to your business, what you're paying for out of pocket right now for personal expenses. And then once we go through that, then we can say, hey, there's about 50%, 60%, 70% of this can be actual trust expenses. Great. So now you only need this much money to actually pay yourself or have on your personal estate to cover certain things, right? So this goes back into that conversation of figuring out what you actually need to live on. And everyone's situation is different. We're not here to tell you, hey, you need a budget, only have pizza once a week, whatever. Live your lifestyle, just do it more efficiently. But it all boils down to what are your typical expenses and things of that nature. So there's a lot of things that the trust can't pay for, and that's when you're going to need money in your personal estate to pay for those things. But and on this, it depends on what you consider fun, food, and fashion and facelifts, because the trust can pay for snacks and groceries for the kids. Okay.
Up
And
to
when you're
age
going
21.
grocery shop, yeah, up to age 21. So, hey, you got kiddos in the house, you're going grocery shopping, go to Publix. Hey, this is for the kids. Going to BJ's or Costco, whatever, right? You're getting some snacks and groceries for the kids. We're not going to go into detail of, okay, Christine had the Capri Suns. No one's like looking at that. So that's just something to understand, that the trust can pay for the food and clothing for the kids. Fun. Okay. Disney World, probably not so, but if you're going to take a trip to a museum, okay. We love museums. We just came from DC and went to some museums. That was a great experience, right? That's something that's really monumental and actually beneficial for a lot of our kids. A lot more beneficial than some of the things that are being taught at schools, but that's a whole other conversation. But trips to museum, site visits. If you're going to go take a trip to California or Texas to go look at some property, that's a site visit. That's not a vacation, right? So the trust can pay for those expenses. Kids' clothing, obviously. If you're the trustee, business attire, right? You're going to meet with some, an attorney or some whatever. You're going to a business meeting for things that are related to the trust. That's a trust expense, right? And then facelifts. Obviously, now everyone's getting the skinny shot. The doctor says you can medically, you have a medical condition or whatever, you can take that. That's a trust expense. And then wellness expenses for trustees. So it's just all in how you put things together and how it's done on the chart of accounts. But there's ways and things that the trust can pay for, and anything that it does pay for, it does it on a pre-tax basis. So that being said, I'm going to go and switch to my whiteboard, and if you have any questions, you can just fire away.
And that's huge too, the pre-tax, when you think of the time value of money, and you all are both investors. So, you can just like do the calculations in your head. If you were saving 25 to 35% on every bill you're paying for that, falls in one of those categories, after 10 years, what do you really have in your own economy? A lot more, if you do it efficiently.
Question regarding the structure for business. So if you have a business and you were talking about, GP and LP status, what can go wrong there? I always like to figure out what's the worst case scenario. What can go wrong there?
You want to make sure. Go ahead. I'm sorry.
No, I was just going to say, sometimes when I'm watching a lot of different videos and they get into, different ways that sometimes it doesn't always qualify. Like I know, well, maybe like in S Corp, you can't have an LP, right? But in an LLC, you can. So can you just explain that a little bit?
Well, for the limited partnership, you want to really make sure that you do this correctly and that you sell your membership certificates to the trust first. Okay. Go ahead, Stefan. You can draw it out.
Yeah. So, I mean,
I just want to be clear on that whole structure, how it interacts with each other and what could go wrong.
Yeah, no, good. So, I mean, the first thing is to definitely understand that S Corps are not good with the trust. S Corps are no. Okay. 99% of the time, well, I should say 90% of the time, it makes sense for people to just go ahead and get an LLC instead of a straight S Corp. And that way, obviously, they can go and elect to be an LLC, a multi-member LLC, right?
Yeah.
But a statutory S Corp, incorporated, just doesn't work for the trust. For that reason, we can't do limited partnership agreements. There's very little we can do to siphon money into the trust from a legal standpoint. There are a few exceptions. Yes, you can pay a fee to a business trust. There's different types of things, but we typically don't like to work with S corps for that reason. Most of the CPAs will just say, hey, listen, if you have to keep your S corp, we're not going to do a trust with you. It's just that simple. So that's just kind of, our position, our back office. Some people are a little bit more liberal, but we typically say if it's an S corp, no go. LLC, right? With a multi-member LLC, much different scenario because yes, then we can, like Michelle said, we can set up first of all, we'd have to amend the operating agreements, right? That's super important. So you have to amend the operating agreements. And then we would sell the membership interest, which is an income interest, not an ownership interest. So when we sell interest over, it's income interest only, okay? Because every LLC is going to have income, right? So that's when we say own nothing, control everything, we really mean own nothing. There's nothing that this trust is owning. We don't own any type of active income. And that's where people get in trouble with these dynasty trusts is they have ownerships in S corps or corporations, right? C corps. They have shares in companies, and a lot of times they control those companies, right? That's called self-dealing. That's not good. So you can look up that word, self-dealing. Anytime you see self-dealing, the IRS is going to come down really hard to that, okay? So we want to try to avoid that as much as possible. And so the proper way to do it would be, yes, have it be a multi-member LLC. We're going to amend the operating agreements. We're going to sell the membership interest, but it's going to be an income interest, not an ownership interest, not ownership interest. Okay. Ship interest first. Okay. So we're going to sell that to the trust. First, make sure that's done. And that's when we can start taking in the LP income. Okay. So the LP works. It's a great structure for people that have active income. When you combine this with having the dual trust structure, so what we'll typically do is have a business trust, okay, and your family trust, we'll call it family trust or beneficial trust. This is where all the assets are, the cars, the houses, the investments, all the assets are in here. This is essentially just a flow through. Okay, so money just goes in here. But this allows us to do is allows us to have a lot more control and anonymity, because this limited partner interest, I'm not sure if you're familiar with the whole BOI stuff that's going on now. That's a huge thing as far as privacy, right? So by having a dual trust structure, it's great because, and let me just clear all
Yeah, I
this.
was gonna ask if you could clear and just,
Yeah.
LLC and then the business.
Yeah, because yeah, what this allows us to do is say, okay, let's keep that LLC, multi-member LLC, and the general partner or managing partner, that's going to be you, right? But this limited partner interest, which again, it doesn't have any management, no voting rights, nothing. It's literally just a silent partner. We can associate that with the business trust, okay? Instead of the family trust. And the reason why is because if something happens with this LLC, if this LLC gets sued, right? Someone sues this LLC, right? They're going to go through discovery. They're going to need to look at all the documents of the LLC, see who the general partners are, the limited partners are. And so we can disclose this business trust fully and faithfully, right? But remember the privacy, when we talk about these trusts, we're talking about asset protection, asset privacy, than tax control.
Can I say something right there? I want to just reiterate that business trust, nothing's held there. That's a flow through.
Yeah.
So
So
yes,
yeah,
it's a limited partner, but all your stuff, that family trust, otherwise known as your beneficial trust, is the recipient, is the beneficiary of that business trust. And that's what they cannot penetrate.
So the family trust is the dynasty trust. That's what we're calling
yeah.
it. The family
They're
trust.
both dynasty trust. It's just this one is going to distribute income. This business trust distributes at the end of the year. Okay.
Dynasty is just the class of trust.
Yeah.
What type
Yeah.
of trust? Like,
Yeah.
like a living trust is a living trust and it's a
Mhm.
statutory trust.
Yeah.
Dynasty is the class of trust and it's a federally chartered entity. It's not based in state, it's contract law. It's based in contract law.
Okay.
And it's not controlled by the state legislature.
Yeah. And the key thing with the dynasty part of that is that we're because all this is tax deferral. A lot of people like to say, oh, this is this or this is illegal. This is tax deferral. It's no different than a 401k or IRA or SEP or anything like that. We're just deferring for generations. Deferring
Right.
up to
No
1,000 a year.
RMDs, no
Okay.
required minimum distributions at 72 and a half.
Yeah. So this is, yeah.
So you have the business trust set up. Can that receive, so say there's a couple LLCs or we're involved in a couple different business things. Does all that flow into the business trust?
Yep, you can.
So multiple things can go into the one
Yep.
trust.
Yep.
Okay. And then you're saying distributions at the end of the year? Or
Yes.
can it happen regularly? You can
It's
only
gonna, well, you can have it monthly or whatever. The whole point is at the end, from a tax standpoint, whatever the net income is. So let's say, the gross, you make $1 million, right? You make $1 million, you have 500K in expenses, right? The net income is 500K from this business trust. Well, that net income, if at the end of the day, because this has to distribute, this is taxable. Okay. This is taxable. And obviously at trust rates, you're paying a lot of taxes. But because we have a family trust relationship with this business trust, essentially the family trust is the beneficiary of this business trust. Okay. This is the beneficiary. Remember, every trust has the grantor, right? The trustee, and then the beneficiaries, right? So this trust at the bottom is the beneficiary of this trust. So that income that's distributed at the end of the year, this trust can declare it not as income, but as an extraordinary dividend, okay? Which is not taxable. So I can have
Ordinary dividends
$500,000.
are not taxable. That's
Yeah.
correct.
So that's how you're
That's how you
flowing
legally
through.
avoid it. Mhm.
Yeah.
At the end of the year, whatever you have left
Yeah.
over becomes an extraordinary dividend.
Dividend. Yeah. So it's a return. It's basically adding that income to the corpus of this family trust. When this family trust does not distribute.
Yeah.
Okay.
Yeah. Okay.
Well, it can, but if it does, you're going to pay tax, and we don't want that. So this one, it has to distribute. This one can choose whether to distribute or not. Okay.
And the reason why, just to solidify my knowledge on the way it's structured, whether you have to distribute or you don't have to distribute, is that based on how it's, is it
The code.
the code, right? So what code,
Exactly.
just clarify again, what code makes you distribute it? Which one does not?
Complex or simple? The complex or
Okay.
simple codes.
Simple codes mean you have to distribute. Most trusts utilizes simple codes, 99.9% of trusts, and you don't want to distribute, okay? This dynasty class of trust has the complex code.
Yeah.
Okay? And where you have discretion to
Yeah.
distribute if you want or not. Like
Yeah.
you can even, pay yourself a salary from it as a trust administrator and
But that's not a
distribute if you want.
distribution. Yeah, it's not a distribution. But it's so this one requires a simple provision. This one is dual track. So it's a complex with a simple provision. So this one at the top it's a simple trust, so it's going to distribute. This one is a complex, but if we want to, because if it's only complex, then we can't distribute. So we want the ability to choose distributions, but we don't want to have to. We're not required to distribute, like Michelle said.
So the
So
simple, the top one, because it's a simple, it has the grantor in it, right? So when you have a grantor,
no, this is still going to be non-grantor.
oh, it
I
is.
was,
Okay.
yeah, it's still going to be non-grantor. And next week I'm going to go over in detail with non-grantor, grantor, trustee, how that all that works, beneficiary.
Okay.
But it's just remember to set up a trust, you need to have a grantor,
Sure.
right? We're just resigning the grantor once it's set up.
Okay.
But it's still gonna, so it's the same type of trust, same provision. It's just that simple provision. But
Okay.
the thing is, again, from the privacy standpoint, the reason why this is
Mm.
such a much more efficient way of doing things is because if this LLC again gets sued and something comes up in discovery, we can disclose, this business trust relationship in good faith. Okay. But nothing has to be disclosed from the beneficiary standpoint of this business trust. So
And then the business trust, because the business trust is a partner, it's getting money in. How can the business trust operate as a business? Does that pull a
yes,
P&L and a whole?
exactly. And that's one of the things when it comes to, depending on how you're set up and if you have to hold a license, a lot of people can run their businesses through a business trust entirely. You don't need an LLC, you don't need an S corp, you don't need anything. Okay? Because this again is the same thing. It has a bank account. Let me just clear all this.
Yeah.
Bank account, EIN, 1041 tax return every year, profit and loss, balance sheet. Okay. Same thing. Business trust, family trust, both have the same thing. So you can operate your businesses from the business trust. We have a lot of clients that do it. We do that ourselves, but it depends on, if you're, in the medical field, you're an attorney, have certain licenses, maybe they won't let you operate with trusts.
Right.
Um,
And you need to
but
understand the LLC.
and that's when you get the LLC. And obviously from a financing standpoint, that's really the main reason why people would have LLC is it's much easier to get financing and loans and things of that nature. So if you have to have an LLC, by all means, but just don't keep a lot of money in the LLC because it's a large lawsuit coming,
Yeah.
right? So
Yeah.
and that's what
So
the case allows you to
on
do.
that note, for getting financing, how is it from these trust structures to get financing? Or is that something that doesn't happen within the trust structure?
You can. There are some banks that do. It's typically not going to be for like commercial loans, primary residence, home loans, things of that nature. Yes. It's actually a lot more easier to get because there's no income verification, meaning we don't need to look at tax returns or bank statements, things of that nature. As long as you have a decent credit score, like 700, you can just do a trustee letter. It's called trustee letter and qualify for a loan with pretty much nothing down. But it's only for primary residences. So if you're into, real estate investing and flipping and stuff like that, that you're not going to get a whole lot of funding because there's no recourse with these loans, with these trusts rather.
Yeah.
So that's when it's better to have an LLC, much easier. You have personal guarantee, all that stuff. So hopefully that makes sense. But that's when you want to keep your LLC if you need that type of funding.
Yeah. But also, I'm sorry, go ahead, Christine.
No, I think that was Isabella.
I was gonna ask, so if you keep your LLC open and you start buying properties and first turn it over into the LLC, and then once you have that under contract and everything, then can you put it under the trust? Because I mean, to me, I would also be wondering, like how am I going to be able to get loans if I need that? So would
Yeah.
that be a strategy or?
Yeah, so there's a few different ways to do that. With the real estate, a lot of people that remember, you don't have to, break everything down. You can, oops, it's a little bit too thick. I don't know why I did that. All right, much better. All right. You can keep the properties in the LLC, right? You got all the financing in the LLC. And then just sell them within the LLC. Remember, as long as you're multi-member, you're not going to get killed with those capital gains taxes because only a small portion is going to be going to you as the general partner or managing partner. So you can sell that in the LLC all day, and not get killed with a whole bunch of taxes. You don't have to go and do things that way. The the issue, or I wouldn't even call it issue, the fact is this: when you're selling real estate in your LLCs, remember, when you're selling everything from your personal estate over to the trust, you get what's called a demand note, right? You get that IOU that the trust owes you. So when you're selling things in your personal estate, let's say you bought the real estate, it was, $200,000, and now it's worth, $500,000, right? You put 50,000 in improvements, you made, a huge amount of money. You're not selling it to the trust for 500, you're selling it to the trust for your cost, right? And that's when the trust owes you as that IOU or demand note, right? Demand note, that the trust owes you, once the property is in the trust. When you're selling it in the LLC, you don't get that demand note. Remember, that demand note is money that you can take out of the trust anytime to pay for food, fun, and fashion, and personal use lease, and all these different things, because that's after-tax money. So when you leave the properties in the LLC and you sell it from the LLC, you can do that, and you can mitigate the taxes by having that multi-member relationship with the trust, but you don't have any demand note. So you can keep it the way it is, okay? Or you can do what we call a double closing, okay? Which basically means you double closing, which basically means you're going to sell it to yourself first, okay, from the LLC, and then from yourself, you would sell it to the trust. Actually, it would be a triple closing, because you would sell it to yourself, you sell it to the trust, and the trust would sell it to the new buyer. And so that's how you could recapture some of that demand note money. There's a whole, there's a lot of nuances with that, and the tax team can guide you through that and how that looks like. But there's different ways to do things. At the end of the day, it's about what's going to work for you, what are you looking to do, your goals, what you live on, and then obviously the biggest thing is the liability standpoint, right? We can't remove the liability in that LLC, but we can with the trust, right? So a lot of people say, hey, I want to do my real estate. Once they start making money and they have a good enough capital, they do all their real estate investing inside the trust. Okay.
So the trust then can turn around and take that house and sell it, realize a capital gain. Could you please illustrate this part?
Yeah.
Then you allocate that capital gain back to the corpus of the trust. And now your demand note is funded. You have money to draw against that demand note. So you can, a lot of our real estate investors will actually use that money inside the corpus of that trust to go out and purchase other properties, have the trust sell it, put it back into the corpus of the trust. Like there's different ways to do that.
There's different ways to do it. Again,
Our really back office will really go over that once you onboard and you go into a trust and walk you through all that implementation. But yes, you can, there's different ways to do it. But some people do keep it in their LLC, like Stefan said, it depends.
Does that make sense?
Yeah, I think so. But as you guys continue to have these, you said that next week, what are you going to go over?
I'm going to go over, just trust categories, the trust relationship, trustees, grantor, beneficiary, stuff like that. Just so you kind of understand how the parties work and their roles and how things work from a legal standpoint and a tax standpoint. And then the master class, again, when the master class is out, it's going to help solidify a lot of this stuff too. But there's different ways to do things. There's not a one size fits all type of deal to this. But if you're just starting out in real estate and you need that funding, do things through your LLC as much as you can. But once you start to make money, especially in the trust, because again, you're going to be able to take up to 90% of that income from your LLC and not pay taxes on it, right? That's a huge amount of money. So now you're going to have more money that you're profiting on, that you're not paying taxes on, to be able to invest in real estate. So keep things going in this LLC, and then eventually you're going to need very little from this LLC, if anything. That makes
Gotcha.
sense.
Thanks, guys.
No problem. So I think that's pretty, real quick. Yeah. So the personal use lease, let me just illustrate that real quick. So again, going back to what I was talking about before, personal estate, trust estate. We got all of the properties, your vehicle and your house in the trust. Now we're going to sell everything over to the trust. So we're going to sell over to the trust. Now the property and the vehicles are in the trust, in the name of the trust, right? You're the trustee. And again, you have beneficial interest. Okay, I'm going to write that down. Beneficial interest or access. That's a better word for it. You have access to the assets here, right? So you can live in the trust house, you can drive the trust cars, all that stuff. So because you have beneficial access from a legal standpoint, you can go, utilize those assets. But if you're going to be using those on a consistent basis, again, driving the cars, all that stuff, a lot of people do in their personal estate, they have a business, is what? They'll track mileage, right? They'll do mileage, gas, right? They'll record all those things and write those things off because they're doing things in their personal estate. Obviously, from a business standpoint, trust completely different because again, it's not owned by you. So that car, that house, once you sell everything over, once you notarize that bill of sale and you change hands and all that stuff, you do the deed, it's no longer owned by you. It's owned by the trust. So now it's legally a separate property. You have access to it. Again, you have beneficial interest. And if you're going to be utilizing that asset, you have to justify it through the personal use lease. So that's when you're going to have money over here. We're going to create a personal use lease, which is a contract. Okay. Personal use lease. Okay. And again, that can be nominal. Like for our cars, we do $200 a month. Okay. So $200 a month, $300 a month, whatever it is going to come from your personal estate. And you can do that monthly, or you can pay the whole thing off in a year. It's just a bookkeeping measure. And that is going to be sent over to the trust. And again, this is leased income. So again, just think of it as transferring as a bank transfer from your personal bank account to the trust bank account for whatever you're doing. And that's solidified by that contract. Okay, so you're always going to need money in your personal estate to pay for those things. But everything else, the insurance, all the expenses, everything of those assets are going to be paid for with money inside the trust. All right, so I think that's it. Thank you guys for being on the call. I will, again, have this up on our YouTube page within the next few days, and look forward to seeing you next Tuesday.
And if you know anyone that, may benefit from this, feel free to invite them, let them know they can introduce themselves, what they do, and, build the community. Again, we got this out very late last night. We figured not a lot of people were looking at their email yesterday during Labor Day. Yeah. We were laboring on Labor Day, though, weren't we?
Yeah. We're doing the opposite, right?
But most people weren't. I don't know about you all. I hope you had a good weekend. But yeah, feel free to share it because it's just, it's a lot of information that most people aren't taught. Not even CPAs. There's like one CE CPA course on this in the whole country. So how to do the accounting for all this stuff. But anyway, great to see you. Have a great rest of your week. And Christine, we have a meeting later this week. So I'll see you on that.
All right.
Okay. All right. Take care.
Thanks.
Bye.
Bye.
Thank you.